cost is a lot more than the lunch cost. So hit the lunch meal instead of the dinner meal.
Great practical budget advice, Lynette. Thank you, and Happy New Year, by the way.
Thank you. Same to you both.
I'm still not motivated.
You're still going out to eat every night.
I'm still going to go out in order.
Susan, thank you. We'll see you tomorrow, by the way.
Okay.
And closing bell begins right now.
And welcome to the closing bell. I'm Kelly Evans at the New York Stock Exchange. Bill, where are you?
I guess. I'm at the wall. We're at the CNBC headquarters here where there's a lot of red today, a lot more than we saw the last couple of days. But we have 1 day, 1 hour to go in the trading year. Not that we're counting, but we are following a rather weak market today. And along with these stories, Kelly, this might be the stock of the day. And I will say the closing bell staff has been buzzing about this company for the last 24 hours, ever since we first heard about Civio yesterday on the program. The oil services provider has literally been cut in half today, down more than 50%. And the implications of why this stock is tanking may be much bigger than just this company, right?
That's for sure, Bill. You can read about the man camps that they have built, the big activist investors on either side of this, the fact they wanted to be a REIT and then that didn't happen. Perhaps a tax inversion candidate, that didn't happen. It touches on so many different themes of 2014, most notably the drop in oil. And also coming up, we have another twist in the Sony hacking saga. Now, serious doubt among many in the cybersecurity industry that it was, in fact, North Korea behind the attack. Some say the evidence points to a laid-off Sony employee. So why was the FBI so fast to point the finger at North Korea, and who's got it right? We'll have a special report.
Wow, I love that. This could make a good movie right here. Now, would you share your car? Not once in a while, but every day. Our Andrew Ross Sorkin thinks this is the future for America, and that it will change our economy and the car business. Andrew will be here to explain in a few minutes. I'm not big on it. Are you?
On the idea of car sharing, Bill, I love it. I absolutely love it.
So
I think it's a boon. Listen, for people who have a car, let's say you're an older citizen, you have a car, you drive it for an hour a week, this could be a real way to generate a significant income. I love it.
An older citizen who drives his car an hour a week.
And it sits in the garage the rest of the time.
Who could you be talking about, possibly?
No, I'm just going to stop here and tell everybody what's going on in the markets right now. As you can see from the sea of red behind Mr. Bill there, the Dow's off about 52 points. The S&P 500 and the NASDAQ are off about 0.5%. The S&P giving up 9 points. The NASDAQ about 25. And Apple, Bill, one of the reasons why we're seeing pressure on that index today.
All right, I heard you, Polcari. Let's get to our closing bell exchange here with our guests for this December 30th. There's Winnie Sun from Sun Group Wealth Partners. We have Adam Thurgood from Hightower joining us today. Bill Smead from Smead Capital Management. Dick Burridge from RMB Capital. And the aforementioned Kenny Polcari from O'Neill Securities. What's the motivation right now? Tax selling's over, and traditionally, the markets, when we get to the first trading days of January, you get to move one way or the other here. So what are you doing in the meantime here?
Talking to me?
Yeah.
So here's what I think you do. So here's what I think you see happening. Exactly. Kind of a whole lot of nothing, right? The market's just churning. Nobody's really making any decisive moves in the last 2 days. People are starting to clearly look forward to what's going to happen in 2015. I think all conversations kind of point to 2015 being another good year. Certainly some sectors will be under pressure. As we've seen, we're going to talk about this oil story. It's going to be a big theme in 2015, as well as a lot of the industries kind of being affected by it. But for the next 2 days, you're going to see kind of just this churning. Listen, we're right at the highs. The market returned 12% before divvies. Add in divvies and we're up almost 14%. You can't really sneeze at that.
I know you can't. Hey, Bill Smead, I'm so glad you're with us. And I want to talk a little bit about millennials next year. You were last on this program making some interesting points about their preferences for home ownership. But generally speaking, do you think this is a group that really exercises its influence on the economy next year? And if so, how does that look and how should we be investing?
Well, you folks have had two big stories today. One is the rent bubble, and the other one was just on about people busting their budgets by eating out. Well, if you get married and you buy a house, the rent bubble goes away. And if you get married and buy a house and have a child, you stay at home and eat at home. So those two symptoms that have been described so well by your reports today tell us where we're going in the next 2 or 3 years. And that is the millennials will get married, they will have children, they will want a house, and Andrew's going to have a hard time convincing them when they're commuting 30 minutes each way at $2.20 to share a car. I think he should have brought that up 3 or 4 years ago.
You beat me to it, Bill. I was going to say exactly the same thing. They'll stop sharing cars at this point. Dick Burridge, you know, we've had pretty good numbers here on the economy lately, and the stock market has liked it. But you think if we get a pretty strong number in the new year on the economy, that the stock market might be spooked by that? Why?
Well, I think it's ultimately, I think you are going to see stronger numbers for the economy. And I think the conversations that have picked up steam since the employment data was released earlier this month, more of those conversations are going to take place. Just talking about the possibility of the Fed moving up its timetable and interest rates moving higher will cause a lot more volatility in the stock market. I'm constructive, very constructive regarding the economy. I think the stock market in the U.S. probably ends up higher when we get to the end of the year, but we are going to have to put up with a lot more volatility. And with the U.S. market trading at a premium valuation today based on trailing earnings, I'm not so sure we're going to end up getting the best returns from U.S. stocks versus the rest of the developed world.
Adam, what about you? And what about what Bill Smead had to say? Would you bet on the sort of restaurant delivery services and the renting investments here? Or do you think he's right that we could see a real sea change next year?
I'm not sure about the whole millennial situation. I have a hard time believing that you're going to see a change in behavior that quickly. But to the prior guest's point, I think that the macroeconomic backdrop is still firmly supportive of higher PEs. The U.S. PE multiples tend to be strongly positively correlated to the U.S. dollar and negatively correlated to inflation. And so I'm not so sure that you're not going to see a pickup in PEs next year. And when you look at expected earnings, we're looking at about 11% growth. And the only way that you get a PE expansion in a period with earnings growth is if the market goes up at a faster pace than you see earnings grow. And so if we see earnings materialize and get some PE expansion, we could be in for a stellar year in 2015.
Yeah, but Adam, and we certainly could, but a strong dollar and low inflation, if that was the catalyst for PE expansion, we should have seen it in 2009.
Well, there are definitely times when it doesn't hold perfectly, but over the past 4 or 5 years, we've seen the dollar improve and PEs go up, and inflation over the longer period has been a strongly negatively correlated factor towards PE ratios. So I'm still in the camp that I believe that multiples can expand, and that'll be a positive for the market in the year to come.
Winnie's son, it's sort of been in vogue this week and last week to say that you expect Europe to outperform the U.S. I mean, you know, I guess they're down so far that the only direction you go is up at this point when it comes to European markets. But really, when you think about it, make the case. Why do you think that Europe is a better place to put your money right now?
Well, Bill, I think the thing that we need to emphasize, whether you be a millennial or you're a retiree, 2015, your New Year's resolution should be to invest. And Europe is actually a great sector that you should have. You should have international diversification. We are in a global economy. And also, we've had some pretty depressed levels the last 6-9 months. So if you're looking for value, if you're looking for opportunity, I really like the story of investing in Europe.
Bill, how are you guys playing? How does Smead Capital play the trends that you're talking about?
Well, yeah, the Main Street is much more likely to outperform Wall Street in 2015. And I think Jamie Dimon, about a year ago, he said, you know, when the United States economy takes off, I think it's going to blow people's doors off. And you know, what if we start growing at 4 and 5% regularly for 2 or 3 years? And what if millennials do begin to demand money? What if banks see velocity of money go up? Then, you know, the Berkshire Hathaways of the world and the Gannett's with their local affiliate television stations with their automobile commercials and their local newspapers, and you get the multiplier effect. This economy that's operated with people hiding underneath their bed. They're all going to come out of underneath their bed at the same time, and we want to get in the way with that, with companies that are domestic revenue. And no offense to my friends, but just because Europe's cheap doesn't mean it's dynamic. And I've been there 3 or 4 times in the last year and a half, and I just don't see the vitality that our 86 million millennials are going to provide our economy.
You know, I'm going to sound like a whiner, but what happened to the baby boomers? Do we not matter anymore? I realize there's a lot of millennials out there, but the baby boomers have a tremendous amount of buying capacity right now, William.
Well, Bill,
it's fantastic. You got the 2 largest I'm a baby boomer. The 2 largest population groups are going to be getting after it at the same time. We're healthier, happier, and have more money to spend than any group of 55 to 70-year-olds in history. So it should be a very strong economy.
So why are we talking about millennials who only want to rent and borrow cars? I mean, that doesn't help the economy much.
Because we're coming off of Jeff Who Lives at Home, the 5-year engagement, and really bad Seth Rogen comedies about relatively useless 27-year-old males.
Bill,
I would need time, Kelly.
It's more
Bill,
than
I
that.
would say.
Go ahead.
Bill, I would
I
say
want to
that.
hear from everybody else on this. Who else agrees with Bill that we're going to see a change next year? And I'm impressed, Bill, that you're so willing, you're so convinced this is going to happen. You guys are investing behind it. Kenny, are you convinced?
Listen, I think he's right. I think it is going to be a strong economy next year. But I got to tell you, on the European side, you make the comment about why, just because Europe has underperformed, why will it be strong next year? Look, in 2009, when we were at the depths of despair and our economy was nowhere, we started ignited the biggest rally that we have known in the last 5 years in March of 2009. It's got nothing but straight up, and our economy was nowhere near in the condition it was today. Yet the market was suggesting that things were going to improve at some point, and in fact it has. Why can't Europe? And I actually see, and I think the conversation yesterday was Europe is in that same position now, right? They're on the cusp. They're on the verge of exploding and getting out. And if Mario Draghi comes out in January, like he says, and he starts to stimulate the same way the Fed did in 2009, then I think Europe's a great place to be.
I agree. I completely agree with that, and especially European exporters that are focused on U.S. businesses and consumers. The QE program that will be put in place will put downward pressure on the euro, and that's going to make those companies even more attractively positioned.
Dick,
Most importantly is your time horizon.
Winnie, yep. Quick last word from you two.
Yeah, the most important thing is your time horizon. If your time horizon is long, there's no reason to be scared of Europe.
That's right.
There you go. All right, I guess we're asking you folks stick around for a moment here. We got a quick break to get out of the way, but we'll bring our panel back here and talk more about where to invest in 2015.
I love it. We've got about 50 minutes to go into the close here, Bill. Markets, though, still seeing red across the board. The Dow's off 41 points, about 8 on the S&P, 23 on the NASDAQ, and this on a day when oil finally held in there.
And still to come, I cannot wait for